Supply and demand zones are the most important thing you'll ever use in trading. They're the backbone of every profitable system. But the problem is, almost everyone does it wrong. They mark them at random spots, they're all over the place, and they're basically just oversized support and resistance levels. And that's bound to fail because you're just guessing. Sometimes it works, sometimes it doesn't. You have no consistency. But real supply and demand zones don't work like that. Real supply and demand zones show you where institutions actually place their orders and move the market. And once you find them, they're permanent and insanely accurate. So in this video, I'm going to show you exactly how to find them step by step so you can start trading zones that actually work. Now here's the difference when it comes to regular supply and demand zones versus institutional supply and demand zones. Regular zones are based on what you see. They're based on price action. You see a strong rejection, you draw a box. You see the price bounce a few times, you mark it as a level. It's all visual. You're using your eyes to find patterns and hoping they repeat. But that doesn't tell you where the orders that move the market actually are. You're just looking at what already happened and assuming it'll happen again. But institutional zones are based on volume. Volume shows you where the big players are. They can't hide it. It tells you if there's real money defending a level. So once we find these zones, the market basically telegraphs its next move. We know where it's headed before the price even gets there. So how do we actually see this volume? How do we find where institutions are positioned? Luckily, we don't need to get some insider info or use some type of algorithm. We just need to use a tool called the volume profile. We have regular volume, which is the volume by candle, and that's the one everyone knows. But the volume profile tells us the volume by price, and this is insanely powerful. It shows you how much trading happened at each price level, not over time, at each specific price. And when you see multiple sessions with heavy volume and activity stacked at the same price, that's where institutions are. That's where liquidity is hiding. So to pinpoint these exact areas, it just takes 3 simple steps. The best part is you only need to do this once. And this is starting from just a blank chart on TradingView on the 1 hour. So step 1 is to add your volume profile indicators, specifically the session volume profile, or SVP, and the visible range volume profile, or VRVP. Now in TradingView, go to the Indicators tab and type VRVP. Then add this one, and then you're going to go into the VRVP settings and change the row size from 24 to 200. You can also change the color to gray if you want, like I do. And once you have that set up, it should look something like this. Now we need to add our second volume profile, which is the session volume profile. So go into the indicator bar and type SVP. Then add this one to your chart. Go into the indicator settings and change the row size from 24 to 100. Now your chart should look like this. You have both the visible range volume profile and the session volume profile. And then you just want to make sure you're in the most recent price range and you've taken all the relevant price action within that range. This is because the VRVP will show you the volume that's visible on your chart. So you want to make sure all the right information is there for us to draw our supply and demand zones accurately. You only need to include the last couple of days and not really more than that. So once you have both VRVP and SVP on your chart, you're on the 1 hour and you can see all the relevant price action, then you're ready to move on to step 2. And step 2 is to find your anchor point. So now you have your price range and you can see all of the volume traded there. This is where you need to find your anchor. This will be your most important supply and demand level because it's the one that you'll base all of your other supply and demand levels on. So it's absolutely critical that we get this part right. But finding your anchor level is actually pretty simple. It's just 2 requirements. The first is going to be on the SVP. Now for the SVP, the key here is the POC, which are these black horizontal lines. The POC is the point of control, and it represents the highest volume point for the day. So it shows where there was the most activity for the day. Now, this may or may not be important on its own for the day, but if we get 2 or more points of control around the same level, it's the market telling us that it's probably an important point for institutions. Multiple days where the market is testing the same point means something's there. And once we find a level that has 2 or more POCs in it, we can move on to the second requirement. And this one involves the VRVP. Now on the VRVP, we have high volume nodes, which are the largest volume clusters, and low volume nodes, which are the smaller clusters. Actually, I made a video that goes deeper into the volume profile that I'll link here for you to watch later. But all you need to know for now is that high volume nodes represent high trading activity, and therefore make it more likely to have institutional participation. But of course, not every high volume node is an important point, because that would basically cover the entire chart. So to find the right supply and demand level, we want to find a high volume node that's aligned horizontally with two or more points of control. This is a combination of the highest daily activity and the highest activity overall, which will show us very clearly where institutions are hiding. It can't get any clearer than this. So, what we want to do here is mark our anchor point. You're going to grab the rectangle tool and make sure that it's extended to both the left and the right in the settings, and then place it where the POCs align with the high volume node. You're not going to want to make it too thin or too wide. It should cover the area with the high volume node where the volume tapers off. So for example, this is on the ES, and that anchor point would be about 10 points wide here. Now once you mark your anchor point, we can move on to step 3. And step 3 is to mark the other levels using market rhythm. So at this point, the volume profiles are done being useful. We don't need to use them anymore, and we can remove them from our chart. Think of them as shovels we use to dig and find the main pipeline underground. Now that we've found where the pipeline is, we can trace the entire network from that point. It's not like we need to find another spot to dig to find the institutions. We've found them already. Because here's the thing, volume changes over time. The price might build volume in certain areas and change the way the volume profile looks. So you can't really rely on the volume profile itself beyond the initial point. Instead, market rhythm takes over here, because that's something that never changes. The market might look like it's completely random and unpredictable, but that's not true, or we wouldn't be able to trade it. It would have the same odds as blackjack, or probably worse. Price action in candlesticks might look random, but that's just because it's tons of buyers and sellers constantly placing orders. And you don't know when or how those orders are going to come in, or what they're going to look like. That's why the market feels unpredictable. But in the background, institutions are carefully moving the market to different liquidity pockets so they can get their massive buy and sell orders filled. And these liquidity pockets appear at a certain increment. On ES futures, it's typically every 20 to 30 points. So that's how far institutions move the price from one zone to the next before they stop and reassess. And finding these liquidity pockets is simple once we have our anchor point. You're simply going to copy the level and paste it at a point that's 20 to 30 points above. When it comes to finding these levels, focus on looking for strong rejections on both sides. So if we see really sharp bounces whenever the price goes near that level, that's signaling something. Because retail traders don't have the ability to move the price like this. The only ones that can do this are institutions. And that's the continuation of the market rhythm. So all you need to do is copy this level and then continue adding them to levels that are 20 to 30 points above and below. It's just a chain reaction from there. This is how we finally mark all of our institutional supply and demand levels, which are permanent. This means that whenever the price will move back there in the future, it'll still work with chilling accuracy. And same thing for all-time highs and above. When the price is at all-time highs, we just make a projection of another 20 to 30 points above. And since the market always moves at the same pace, we can expect these levels to be accurate targets in the future. That's the key. So find your anchor point, and once you've found that, you've hit the institutional pipeline. Now you know where they're going to move in the future. They can't hide from you anymore. It's incredibly simple, and it works. Now let me show you how these would play out in the real market. And by the way, if you want to master finding these levels and trading them with precision, join my accelerator program. You'll get access to a custom indicator with these exact levels mapped out, as well as private one-on-one support from me and a private community. If you're interested, the link is below. But these are the supply and demand levels fully mapped out on the ES. This is my exact chart that I use to trade every day, and I found these institutional levels with the exact method I just showed you. So let's see how these levels hold in the future. And here we see that the price reacts quite accurately to the levels that we marked. We have an accurate picture of where the market might move next, and that's extremely powerful. It means we know precisely where to enter and where to target every single time. This is what's known as level-to-level trading. Instead of trying to interpret price action or blast some indicators on your screen. We just have a very consistent and repeatable way of entering trades. We enter at one level and exit at our target level, and we just do this over and over. But we also don't just want to do this randomly or at every single level because that would be pretty exhausting. So I use the level, confirmation, and execution method, or the LCE method, to know precisely where to enter trades and in which direction, so that I can raise my win rate and risk reward. I'll link another video here where I go more into detail on exactly how I trade LCE, but this is why these zones are permanent. I marked these levels once, and they've been working for years. Same chart, same zones, and same reactions. That's the power of institutional supply and demand zones. Mark them once, then trade them forever. If you got value from this, drop a like and hit subscribe, and I'll see you in the next one.